Hello and welcome to Portfolio Matters. As you'll all be aware, we are seeing surging inflation throughout the developed world. And I am often asked what we can do to protect ourselves against inflation if inflation continues to rise and becomes persistent. And in thinking about that, I realized that actually there is a live experiment going on right now in the world in Turkey, where the central bank has actually cut interest rates in the face of rising inflation, leading to runaway inflation. So the question is, what have Turkish investors done to try and protect themselves against inflation? Okay, so the summary of this podcast is going to be that in order to protect yourself against inflation, you need to have either hard assets, so equities, property, gold, or overseas assets, so assets that are denominated in a foreign currency, preferably a hard currency such as US dollars. And reminder, the US, uniquely amongst central banks, has indicated that it is going to raise interest rates hard and fast to combat inflation. In contrast to the ECB in particular and the Bank of England, which has today announced that it sees inflation peaking at above 11% in October, but has raised rates to just 1.25%. Global equities could also be an alternative. Finally, you could buy inflation-protected assets, but there's a big caveat attached to inflation-linked bonds, in that they only really protect you against inflation once interest rates have stopped rising. And I'll show you a graph illustrating that point later. Now, the other thing to be aware of is that inflation is a tax on wealth. And even if you manage to protect yourself against inflation, you will be taxed on the gains in your nominal wealth, not your real wealth. So let's say that inflation over the course of 5 years is 100%, and you have put all your money into gold, and the gold price in US dollars, let's say, has not changed, but it's doubled in sterling terms. Now, in US dollar terms, your wealth is unchanged. You have exactly as much gold as you did 5 years previously, but in sterling terms, your wealth has doubled, and the government will tax the increase in your nominal wealth in sterling at 20%. So you need to be aware of that and try to protect yourself against that tax by either holding your assets, as many of them as possible, within a tax-efficient wrapper such as a SIP or an ISA, or if you're wealthy enough, consider putting your money offshore, because the reality is your wealth hasn't changed. What's happened is inflation has increased its nominal value, which is then taxed, but not its real value. Okay, so going back to Turkey. So what is the economic situation in Turkey and how did it get there? So this is a long-term chart of inflation in Turkey, and you see that it has a history of high inflation. But in 2001, the Turkish Central Bank was granted independence with a price stability mandate and raised interest rates to get inflation under control. And you can see that that was very successful. And then there was then a decade of very low inflation. And here you'll see that when the central bank became independent, it acted swiftly to raise rates to 100% to tame inflation. And that brought inflation right back down and sparked off a boom in the economy, which we will get into. Now, and all was going well until 2014, when an Islamist, President Erdogan, was elected, and he believes that usury, i.e. paying interest, is immoral. And you can see that granting the central bank independence sparked off an absolutely enormous economic boom. The country's GDP more than quadrupled in just over a decade, until President Erdogan was elected. But the central bank was very firm about keeping monetary growth within the country contained. And so in order to fund that economic growth, Turkey borrowed very heavily from overseas. And so this is private debt. This is external debt. You see that it grew incredibly strongly, quadrupling with GDP in the period 20 years between 2000 and 2020. After President Erdogan was elected in 2014, relations with the EU deteriorated, and in 2016, Turkey's application to join the EU was overwhelmingly rejected, primarily on human rights grounds. And following that, foreign investors became more reluctant to invest in Turkey. Tourists became more reluctant to visit. The current account hence deteriorated, and the value of the Turkish lira slid in currency markets, making it more difficult for Turkish companies to service their overseas debts with lira earnings. So this is the Turkish lira in the period between 2015 and 2018. And you'll see that the failure of its EU membership bid led to a big sell-off. So following that, the lira slid by a third in the following 18 months. And that meant stress for companies that had borrowed in foreign currencies. But as the lira slid and inflation rose, the central bank raised interest rates to cool the economy and defend the lira. And that was effective in slowing the economy, but at the cost of rising unemployment, and made the government unpopular. So this is Turkish unemployment. We can see from 2018 rose as the economy slowed down. And this is GDP growth rate. And you see again, the economy fell into recession. So that was the backdrop going into the COVID pandemic, which disrupted the country's main sources of foreign income: heavy industry, exports, and tourism. And so Turkish businesses still needed to pay interest and principal on their foreign debts. And so they continued to sell lira for US dollars, and that caused the lira to start to rise and inflation to pick up. So the central bank reacted by raising interest rates to defend the lira. But President Erdogan then intervened and ordered the central bank to lower interest rates. So at this point, the central bank ceases to be independent. He dismissed a series of central bank governors who refused to obey orders. And he seems to have this idea that lowering interest rates does not exacerbate inflation and is actually good for Turkey because it lowers the lira and therefore makes their exports more competitive, while forgetting that Turkey is heavily dependent on fuel and fertilizer imports, all of which become much more expensive. And the effect of the falling lira can be seen on Turkey's current account balance. It runs a huge current account deficit, which was $5.5 billion in March 2022. And the deficit was exacerbated by Turkey imprisoning a US pastor who was politically connected in the US, and Donald Trump put sanctions on some Turkish exports, particularly steel, I believe. Now, if a country is running a current account deficit, then it has to run a capital account surplus in order to balance the books. But as inflation has picked up, money has started to flee the country. So the capital account has also turned negative. Now, if both the current account and the capital account are negative, the only way that can add up is if the central bank has been selling reserves. And that's exactly what it has been doing. You can see here. It sold the best part of $30 billion in reserves in just over the last 6 months. Now, obviously, that is unsustainable. Real interest rates in Turkey are very heavily negative, and unsurprisingly, that means if you can borrow money at the official interest rates, you have real interest rates of minus 60%. So obviously everyone is trying to borrow money. And so private sector loans are rising quickly. And therefore so is M2, exacerbating inflation, which in May hit 73.5%. And it's still rising. And all the elements are in place for Turkish inflation to continue rising towards hyperinflationary levels. You have interest rates which are actually going lower in the face of rising inflation, and Turkish citizens are losing confidence in their own currency. So this is lira, which is in free fall. Okay, so what measures has Turkey taken to support the lira? Well, in December last year, the government announced a scheme by which depositors in Turkish commercial banks would receive interest equivalent to the fall in the lira against the dollar. So if the lira fell 30% against the dollar, depositors would receive 30% interest payments. And the aim of this was to explicitly stop Turkish consumers from moving their money out of lira into US dollars. Now, and a lot of Turkish commercial banks offer US dollar denominated savings account, and it was to stop Turkish citizens using them and therefore exacerbating capital flight. However, now how are they going to fund this? That means they're going to compensate Turkish citizens with fiscal largesse. And where are they going to get the money from? Actually, if the lira starts to sell off, this measure implies a very large and unlimited liability to the Turkish state. And if they have to print money to pay for it, then that exacerbates inflation. The other thing they have started to do, and this is a private investor's worst nightmare, is capital controls. So in January this year, they required all exporters to convert 25% of their earnings into Turkish lira to support the currency. And they have talked about using more capital controls. And capital controls stop you from moving your money out of a depreciating currency and are wholly bad for private investors. Okay, So how have Turkish investors attempted to hedge themselves against inflation? Well, a surprising choice is cryptocurrencies. So daily transactions in cryptocurrencies in Turkey are estimated to be between 1 and 2 billion a day. The Turkish population is young, tech savvy, and comfortable with crypto. And polls, and we have to treat this data with a pinch of salt, indicate that between 16 and 20% of Turks own some crypto, with Bitcoin being the most popular asset. Okay, now the advantages of crypto are difficult to trace. If capital controls come in, that is potentially a way of getting around capital controls. And if a stable coin such as USD coin or Tether were fully collateralized and were actually a stable, then that would be a good hedge. But at the same time, how do you buy your cryptocurrencies with Turkish Lira? At some stage, the crypto world has to intersect with the commercial banking world. And if the government were to put capital controls limiting those transactions, then that would limit your ability to buy crypto with Turkish currency. The disadvantages are it's extremely volatile. Frankly, it's of questionable long-term value. Is it really an asset or is it a speculation? And it's insecure. It's liable to theft if held on a local computer, and it's liable to theft if held on the wrong exchange. In March, a man killed his wife and 2 children, then killed himself in the city of Antalya after losing thousands of dollars in Bitcoin investments. Not great. Okay, so this is the performance of Bitcoin in US dollars, which is in blue, and in Turkish Lira, which is in orange. Now, if you had bought it back in 2020, you would probably be all right in that your Bitcoin, even after the recent sell-off, is up 330% in Turkish Lira, and actually it's up 100% in US dollars. But obviously, if you bought it at the beginning of this year, much less successful. It's down 44% in Turkish Lira terms, when Turkish inflation is running at 70%. So it's been a wholly inadequate hedge against rising inflation. It's massively destroyed value, even in Turkish Lira terms. So what about property? Well, these are house prices in Turkey. The red line is the nominal price per square foot. And you see that it's risen very strongly. And the blue line is inflation adjusted. And actually, I'm quite impressed. Property has been a good inflationary hedge. Presumably, there's a lot of demand for hard assets. So house prices are bid up. So this is the MSCI Turkey index in local currency. And it's absolutely shot up as investors have bought equities to hedge themselves against inflation. And in US dollar terms, it's kind of flat. So we know this year has actually been a very poor year for equities worldwide, but actually the MSCI Turkey has held its value in US dollars. So that suggests to me there's a lot of demand from Turkish investors for equities as an inflation hedge. What about Turkish bonds? Well, unfortunately, I don't have the price of Turkish bonds in Turkish Lira because they're not listed on external exchanges and I can't get hold of that data. But we can see 10-year bond yields have fallen. So Turkish 10-year bonds are yielding 19% when inflation is at 73.5%. Very poor. If you invest in Turkish bonds, you are losing a lot of money in real terms. Bonds are not a good inflation hedge. And if we look at Turkey's foreign debt, so this is the US dollar bond. Now, bear in mind that the interest is paid in US dollars. So these bonds should not be exposed to a sell-off in the lira, but their price has fallen quite sharply, admittedly in line with global government bonds. But bonds in general, very poor inflation hedge. Now, what about gold? Well, this is gold in Turkish Lira. Gold has been a great inflation hedge. So if you want to move your money into a hard asset, gold has held its value. Now, what about index-linked bonds? Well, sadly, Turkey doesn't have any index-linked bonds, so we can't really test how they've performed, but we can look at how UK index-linked gilts have performed, and UK index-linked gilts are listed on the London Stock Exchange. This is the 2042 index-linked gilt, and you'll see that its price has fallen very sharply over the past 6 months as inflation has risen. And if you didn't know better, you might expect index-linked gilts to rise with inflation and to provide a good inflation hedge. And that is only true once interest rates and interest rate expectations have peaked. In a rising interest rate environment, gilts behave like normal bonds. Essentially, an index-linked gilt, its value rises with inflation. So the 2042 gilt, you will get back a lump sum in 2042 that rises with inflation. And the value of the bond is that lump sum discounted by the interest rate. And as interest rates rise, so the discount value of that large lump sum in 2042 declines. And hence, index-linked gilt values decline. So bottom line, if inflation becomes persistent, you need to move your money out of cash and bonds into real assets. So gold, Turkish investors have absolutely achieved wealth preservation with gold. Hard currencies, as long as there's no capital controls, you can move your money into US dollars, other hard currencies, that also works. Equities has worked, and actually, I think domestic buying of equities has supported the local stock market this year. Property has worked. Index-linked bonds, Turkey doesn't have any, so we don't know. But I'd also caution that index-linked bonds only work once the interest rate cycle has peaked. Now, assets that haven't worked. Cash is awful. Bonds are terrible. Rising inflation absolutely destroys the value of bonds. You can see that the real interest rate on Turkish 10-year bonds is minus 60%. So every year in real terms, you're losing 60%. Cryptocurrencies are volatile, and essentially they're so volatile that they're not a good hedge. And I also question whether there is any long-term value there, whether they're a speculation rather than an asset. And assets that haven't worked, index-linked bonds, well, they could work when the interest rate cycle has peaked. But that presupposes that central banks are raising interest rates to bring inflation under control. If they don't, then index-linked bonds may not work. So final summary, if inflation becomes persistent, the lessons from Turkey are move your money into equities, property, gold, or US dollars. Okay, that's it. Thank you very much for watching. Please, can you press like and subscribe to the channel? And in the meantime, it's goodbye from me, Keith Jordan. Goodbye.
Full disclaimer. The material and information contained in this podcast is for information and entertainment purposes only and should not be relied upon for making a business, legal, or any other decision. We may own or have a financial interest in any securities mentioned. Listeners should conduct their own research or consult a professional investment advisor before making any decisions regarding topics mentioned on the show. Whilst we endeavour to ensure that the information presented on the show is correct, we make no representations or warranties of any kind, express or implied, with respect to the podcast and website or to any information, products, services or related graphics discussed or presented in the podcast or website. Any reliance you place on such material is strictly at your own risk. You are solely responsible for the investment decisions you make. We will not be responsible for any errors or omissions in the podcast or website, including in articles or postings, for hyperlinks embedded in messages, or for any results obtained from the use of such information. Nor will we be liable for any loss or damage, including consequential damages, if any, caused by a reader's reliance on any information provided by the podcast or website. Please do not listen to the podcast if you do not accept self-responsibility for your actions.